Welcome to the 2026 Economic Outlook webcast panel brought to you by the Controllers Council, Chief Executives Council, Operations Council, and the IT Executives Council. My name is Neil Brown, CEO of Executive Councils. And before we get into the presentation, let me share some brief housekeeping items. We'll have Q&A at the end of the presentation, so please use your GoToWebinar control panel to ask our expert questions. Next, you'll receive a link to this webcast via email in the next 24 hours, so no need for notes or screenshots. Let's take a quick look at our agenda. First, I'll share a word about our sponsors. Next, I'll introduce our speaker and subject matter expert, and then we'll get right into our presentation, the 2026 Economic Outlook. Finally, another reminder, we'll have Q&A at the end of the presentation again, so please use your control panel. We'll get to as many questions as possible. Very special thanks to our sponsors for making this timely and important presentation possible. Paystand is a leader in AR and AP automation and payments as a service. Anrock is the new leader in sales tax. And Bill is AP automation, spend and expense management, Insight software, finance and accounting automation, FP&A, BI, and more. And last but not least, Citrin Cooperman is tax audit and technology advisors. With that, I'm very pleased to introduce our speaker and a nationally recognized economist, Curtis Dubay, Chief Economist of the U.S. Chamber of Commerce. Mr. Dubay has researched and published frequently on a wide range of tax and economic issues. He's regularly quoted by the press and has appeared often in media, including CNBC, Fox Business, Fox News, and C-SPAN. He's testified before Congress several times and been cited in newspapers, including the Wall Street Journal, New York Times, Washington Post, USA Today, and Politico. In his current role, Dubay tracks the condition of the economy, analyzes the impact of public policy on economic growth, and runs the Chamber's Chief Economist Committee. Prior roles include PricewaterhouseCoopers, PwC, and the Tax Foundation. Dubay received his master's degree in economics from the University of Connecticut and his bachelor's degree in economics and leadership studies from the University of Richmond. Curtis, welcome.
Thank you, Neil. It's a pleasure to be with you and everyone in attendance today. We're going to talk about all sorts of things. We have plenty of time to get into everything that's going on in the economy, and there's an awful lot. A lot of things are contradictory, and I'm going to try to square that circle and put together a coherent picture of what's going on in the economy now, what we can expect for 2026. A lot of things are contradictory because we have, on one hand, economic growth being pretty good and pretty strong. The numbers, the hard data, at least what we have, remember, keep in mind, we did have the government shutdown, and a lot of data has been delayed. But we're starting to get it back in now, and the data we have shows the economy is in pretty good shape. That does not jive, though, with how people feel about the economy. And when I say people, I mean consumers and families and businesses. So if you look at consumer sentiment remains really low. If you look at surveys of business optimism, it remains tepid at best. And yet, when we got the growth numbers for the third quarter a few weeks ago, finally, they were much delayed, showed the economy was growing at 4.3% in the third quarter of 2025. And we won't get the fourth quarter numbers for a while, but all indications are that growth is pretty strong in the fourth quarter as well. So the economy did very well last year when all was said and done. We had actually a negative quarter in the first quarter of last year, if you recall. That had a lot to do with tariffs. Tariffs and trade. Tariffs are causing big swings in trade, so businesses were getting ahead of tariffs in the early part of last year, so they did a lot of importing. That mechanically reduces the rate of economic growth, GDP growth. So we had a negative number in the first quarter, and then they've cut back on import cents. That mechanically pushes GDP up. So when you average everything out, we'll probably get 2% growth for last year at least. Probably might get above that, somewhere between 2 and 3, say. That's pretty good when you consider, again, the vibes, how people feel about the economy, and if considering this pretty significant headwinds that we faced last year. The economy was growing really strongly in 2003 and 2024. It was growing pretty strongly in the beginning of last year, but then you throw in the chaos that came with tariffs and then immigration restrictions. There were some pretty significant headwinds, and then policy uncertainty going through the roof. Some pretty significant headwinds for the economy last year. Taking all that into account, and yet the economy chugged on through it and grew at a really, really strong rate. We could probably grow above that here in 2026. There's a good chance that we could do that. We have to get the right set of policy mix, the right set of policies. Equally as good chance though we get lower growth than that 2% number, that we get 1% growth, for instance. They're equally, the risk to the upside and the downside is equal if we get the wrong set of policies. And I'll get into all that as we go forward. So let's start with, and Neil, you can go to the first slide that shows it's the economic growth chart. It'd be the third slide, the first, there we go, perfect. And here's this shown in chart form. The economy was in good shape in 2024, grew at almost 3%. Keep in mind, the long-term growth potential of the U.S. economy is generally perceived to be, or assumed to be, 2%. So we assume that based on our mix of labor, how many people we have in the labor force, and how much capital, how much stuff, and how much investment we're able to do in the economy will grow at 2% over the long run. We grew above that in 2024. We actually grew above that in 2023 as well, pretty close to 3% in both years. We were probably going to do that last year, but then we had the turmoil of tariffs, and it looks like growth will come in again at that 2% level for the year. You have to average all those quarters together. I think actually probably a little bit higher than 2%, but probably not as high as 2.8%. So growth will be slightly below where it was in 2024, but still pretty good all told. The status quo for 2026 will be, as long as nothing changes, as long as everything kind of stays still, we'll probably get 2 to 2.5% growth. And we'll get that because the thing that's keeping the economy going in 2025 and here in 2026 is consumer spending and investment in AI. But let's start with consumer spending. Consumers continue to spend at a very strong clip. They've been doing this for years now, really to the surprise of many. We've all been waiting kind of for the other shoe to drop when it comes to consumer spending, that they just can't keep up the pace forever. And yet, quarter after quarter, or month after month, quarter after quarter, year after year, they continue to spend at a really impressive pace. That continues up through the latest data that we got for November as of this morning. We got retail sales for the month of November earlier today, and they grew really, really strongly. So consumers will continue to spend strongly up until the end of 2025. We won't get December numbers for a while, but as far as we know, right up to the last month of the year, consumers were spending really strongly in 2025. They're able to do that, and we'll get deeper into this in a little bit when it comes to workforce, because jobs remain available. The labor market is not as strong as it was. It's certainly slowed down compared to, say, 18 months ago, even 6 months ago. It's not as strong as it was. But jobs remain available, and those jobs pay pretty well. And average wage growth is above the rate of inflation, and it has been for a long time. And that is recipe for allowing consumers to continue to spend, even as the affordability crunch remains in the forefront of people's minds. And there's no denying that affordability is a big, big issue. There's definitely some element of what people refer to as the K-shaped economy, which is high income people are spending an awful lot. They're doing that with growing wages, and they're doing it through a wealth effect. That the stock market, the very strong stock market we've had for a while now, is allowing them to spend more and really drive that spending number higher. We got an interesting report from Delta Airlines this week that said that they had a really good quarter for earnings, but it was mostly driven by spending on first class and business class airfares. Wasn't for economy class. So that's a kind of a microcosm of what people are assuming is driving consumer spending. There's certainly something to that. There's no doubt that is helping keeping consumer spending up. But middle and lower income families and people are spending strongly as well. It's just that they're using their wage growth to keep up with affordability. The things that are rising the most right now in terms of prices are housing, food, clothing, and electricity. Not so much energy in total because gas prices have come down, but electricity. Those are necessities. There's no escaping that. And the other thing that's really difficult for, this is very front and center for the president and the administration, the affordability. This is why you're hearing about rate caps on credit cards and other initiatives from the president. But things like food and clothing are heavily tariffed. And that's showing up in prices, and people are seeing that and they're responding to it. So that's the consumer side that's driving growth. On the business side, it's really investment, and it's investment specifically in AI. Investment has pulled back for things like business structure, so buildings. Those are more expensive because of tariffs. But in terms of building things like investing in equipment and other things that relate to data centers, that's been going through the roof. I should have said I expect that the consumer strength, the consumer spending to continue into 2026. The same goes for investing in data centers that support AI. That is going to continue because there is strong demand for it. We're expanding the applications of AI, and that is leading businesses to put a whole lot of resources into expanding its capabilities and capacities and their ability to provide it to all of us. Just those two things alone will keep the economy growing at 2% this year. The key thing to remember with AI is that there's two things going on at the same time that are really helping to drive economic growth. One is that it requires physical investment that I just talked about. So there's a lot of stuff being created around the country. There's a lot of business buildings going up to house all the computers and servers that are necessary to generate and produce AI. That's a lot of construction jobs, it's a lot of jobs in HVAC, a lot of jobs in electrical, a lot of jobs in water systems, all the different things that go into making a data center and putting it in place. That is a big part of driving growth right now. The other thing that is helping to contribute to growth from AI is productivity. Productivity growth in the US is really, really strong. And that is a US only phenomenon. And that means that workers are producing a heck of a lot more with the same number of hours than they were before. A lot of that is AI. There's other technologies and other things that are boosting that as well. But right now, we have even in the run-up in AI predated really, the run-up in productivity predates AI. So we have more capacity, more runway left for AI to continue to boost productivity. So that's a really good news story for the economy and for growth. Keep in mind, we're going to need AI, and again, I'm going to get into this in a little bit, because we're short of workers. We don't have the workers we need to get to say 3% growth. There's just not that many out there for a variety of reasons, and it plays into kind of changing perceptions on the labor force. But we're going to need AI to get to stronger levels of growth going forward. Okay, so if nothing else changes, the economy will grow about 2% this year. We're by no means hemmed in or stuck at 2% growth. That's, like I said, that's the long-term growth potential for the US economy, but the US economy is incredibly dynamic. It can grow significantly stronger than 2%. We got to get the right set of policies, the right set of mix of policies to allow that to occur. The first and most important is that, or the biggest thing that would push growth to a higher level in 2026 would be AI being even a bigger factor for growth. So that would come from increased investment. So businesses are pouring a ton of resources into AI, but they could do even more if they discover there's even greater revenue potential than they anticipate. And the productivity benefits are even greater than we think they will be. But what we need is there's real threat to AI that would come from states doing a patchwork set of regulations that would slow investment in AI, and we need to defend against that, and that's what we do here at the chamber. And then the other thing that business uncertainty is going to really cause a major problem. Or sorry, policy uncertainty. Businesses are very, and Neil, there's a slide. I'll tell you where it is. It shows policy uncertainty. The businesses don't like to invest in situations where they don't know where what policy is going to be going forward. We have the highest level of policy uncertainty. This is a measure